Welcome back. You're still tuned into Midcap Radar. Well, let's focus on a company now. CAMS is the stock on our radar. They reported numbers a while back and it was a good set. Revenues from operations, they were up 5% on a quarter-on-quarter basis. Their EBITDA was up 11%. EBITDA margins also increased to 40 basis points, leading to a profit growth of 11%. Now, remember, the equity market flows have been doing well, especially when we talk about the SIP segment. Record high flows yet again in the month of October. So let's see what the impact of all this is on CAMS business. Let's welcome the management on the show. Anuj Kumar, the managing director of CAMS, is joining us now. Mr. Kumar, good afternoon. Thank you so much for joining us. Well, you know, your equity market share grew 120 basis points on a YOY basis in the quarter gone by. You touched that 65.5% mark. Come October, we've seen another bigger flow coming into the SIP space. Large cap flows are back. Has this had an impact on your market share as well? Have you seen further gains? And what is the outlook on overall market share for the year?
Good afternoon, and thanks for having me over on the show. So broadly, as you see, for our business, consumption metrics have continued to do well. Consumption metrics, of course, are a number of investors that the capital markets are adding, especially mutual funds. From a gross flow perspective, you spoke about SIP flows. For CAMS service funds, this number has now crossed 10,000 crore a month. And remember, it used to be less than half this size about 3 years back. Overall, the number is over 17,000 crore for the industry. Our SIP registration number, which used to be in the range of 45 lakh a quarter, has now crossed, this is a gross number, has crossed 60 lakh. And overall, you've seen a growth in overall equity market share, largely riding on a market share on the net sales being at 80%. Now, that's a slightly artificially high number. I'm not expecting 80% will sustain for a long time, but our gains in equity market share will continue. Overall, you saw that our EBITDA margin came up at about 44.8. We're expecting for the trailing quarters for EBITDA margin to hold at about 43 to 44%. So we will hold or slightly improve the margins. For the year, you can expect revenue growths year-on-year basis to be about 14 to 15%. We should have a profit growth of about 16%. So overall, like I said, consumption metrics, which is total collections in the industry, new investors coming into the industry, SIP registrations, SIP collections, all of that has gone not significantly. We're not seeing any reversal in the trend in the months of October and November. So expect this trend to continue.
So just to get, Anuj, afternoon, just to get the numbers in again, 14 to 15% revenue guidance for FY24. Margins should sustain at 43, 44%, or maybe even do better than that in Q3 and Q4. And the profit growth is approximately 16%, right? These are the numbers.
Yes, it's fair to expect.
Okay. All right. Just to stretch the time horizon a little bit, I'm reading an analyst note, and they're saying that a margin improvement from limited fresh investments required in the new initiatives, while higher AUM growth leads or lends operating leverage. So currently, your margins will hold around 44%, give or take a couple of basis points here or there. But what about 3 years down the line? Do you think there is scope to expand margins materially from current levels?
That's correct. If you see what we've demonstrated about a 1 to 2% EBITDA margin up in the last 3 years, largely backed by growth, significant automation in the overall core operations, and productivity gains. So I think while we are not committing that number, I think broadly you could expect that we could grow margins by about 0.5 to 1% every year. So if you took a 3-year margin, 3-year time frame, these margins, which are about 44%, could show up in the range of 46 to 47.
Okay, so 0.5 to 1% margin improvement is what you're expecting going forward as well. You know, there is a substantial growth which is coming in the non-MF business as well for you. Do you expect that to continue, or was that just on a low base? And between MF and non-MF business, which is a higher margin business for you, and what is the difference?
So when you saw the analyst report, you saw that they alluded to various investments we made in the recent years, especially on account aggregator, NPS, and in our insurance repository business. So we are now almost out of that investment cycle, which means fresh investments will be in sales and marketing. Product-related investments are all done. Overall, our non-MF portfolio grew 30% on a constant base, 47% if you took the acquisition revenue of Think360 included in the current year numbers. And therefore, we expanded non-MF share from 10% of revenue to 13%. Overall, I'm expecting this to grow by about 2% a year. So this 13 should be about 15% when we speak a year down the line, and continue scaling at about 2% each year. From a profitability perspective, these businesses, I would say, approximately, although we don't give out these individual numbers, would be in the 30% EBITDA range, which means some of them are still as part of the investment cycle. Mutual funds is mid-40s, but over a period of time, because everything is platform-based and highly industrialized, we will get into 40% margins even in the non-MF segment.
40% margins in non-MF?
Correct.
This is by when? Sorry, I missed the timeline.
This could take about 2 to 3 years.
Okay. And in 2 to 3 years, you believe the consolidated EBITDA margins can inch up to 47% also, right?
Yes, there is a possibility if we continue on the productivity curve, very much.
Got it. I know we keep asking you about the possibility of some, pressure coming in on your yields. But again, in the quarter gone by, I believe your yields on asset-based book declined marginally. Can you explain that? And what's leading to it, and what's the outlook?
We've stated in our earnings call also, and this is public news, that we were resetting core pricing across a couple of contracts. That reset, whenever you go through a large exercise like that, in a large part of your franchise, does affect your pricing. That got concluded completely in the second quarter. And therefore, any contraction on yields will be very small in the next, take about 2 to 3 years. We will show more constant yields, and therefore any depression in profitability coming out of pricing impairment, I think you'll see very less of that.
So there are no more large MF accounts where in the next 2 to 3 years, there is going to be a pricing reset?
Of the kind that we saw, yes.
What was the extent of what happened in Q2? I know you mentioned that in the callers also, but some details on the extent of the pricing reset? And was it limited to only that particular client, or has it happened periodically with all clients?
No, this was largely limited to 1 or 2 contracts, like I've said, which may have been a little out of line with the market, which is the reset we have done. And therefore, like I said, future impairments or contractions will be much smaller.
Okay, all right, Mr. Kumar, thank you so much for joining us today and giving us all those details. So that's the word coming in from CAMS. They have seen an increase in equity market share segment as well. And they are talking about 0.5 to 1% margin improvement every year from here on. Let's slip into a short break. We'll come back with more markets and stock-specific action on the other side. Stay tuned.